Hello and welcome back to ACCA Masters. In the last video, we have seen what is the impact of inflation on discount rate. For example, the discount rate can be with inflation and without inflation. For example, if it includes inflation, then the discount rate will be known as nominal discount rate or money discount rate. And if the cash flows includes inflation, then those cash flows will be known as nominal cash flows or money cash flows. But if it does not include inflation, then in that case, such a discount rate will be known as a real discount rate, or the cash flows which does not include inflation, those cash flows will be known as real cash flows. Okay. Now we have two different types of inflations. First of all, we have general inflation, and secondly, we have specific inflation. Now it is important to distinguish between both of them. If I talk about general inflation, then it affects your overall cash flows. Okay, so it has impact on your overall cash flows in the NPV calculation. Fine, but specific inflation does not affect your overall cash flows. Instead, it may impact any specific area. Let's say material will be inflated by 10%, or for example, let's say wages will be inflated by 7%. Here you can see that we are inflating only specific cash flows. So it is the major difference between general inflation and specific inflation. Anyways, if there is only one general rate of inflation, then in that case the NPV will be same under both of these methods. Okay, but remember, if the question is silent and has no separate information about the inflation, then we will always assume that our discount rate plus cash flows both are nominal in nature. But please remember one thing, we cannot use real discount rate method in the question in case if specific rate of inflation is given in the question. But the real discount rate method is the only possible method in the case of perpetuities. Fine? But to solve any question using nominal discount rate method, we will follow the following three steps. The step number one is to calculate nominal discount rate only if the question has not already provided the nominal discount rate. In that case, we will use this formula to calculate the nominal discount rate. Okay, we have already discussed about it in our previous lecture. Secondly, we will inflate each year with a given inflation rate. Okay, and as a result we will get inflated cash flows, and finally we will use these inflated cash flows and we will multiply it with their relevant discount factor to find NPV. Okay, now we have few further tips. If you are given real discount rate in the exam, then the examiner will clearly specify it. Otherwise, if the examiner has generally stated this word, firm's cost of capital, then we can assume that it is money discount rate or the inflation is already included into it. Okay, and we will use general inflation rate if we want to convert nominal cash flows into real cash flows. And finally, if the examiner is giving you real cash flows instead of nominal cash flows, then the examiner will tell you in such a words, for example, the prices are current prices or today's prices. So if you find these words in your exam questions, then it means the given cash flows are real cash flows instead of nominal cash flows. On your screen we have understanding number 3, which we have already solved in our previous lecture, but now you can understand the wording of this question in a more better way. Please let me zoom in for you. Okay, please read this line. The firm's money cost of capital is 15%. So this money cost of capital is representing it is nominal discount rate. Fine. Now please read this line. Expected net cash flows are $20,000 per annum for 4 years at today's prices. So this today's prices or current prices indicating that our cash flows are real cash flows. Okay. We have already seen the impact of inflation on the discount rate, but there are several other factors too which impacts on discount rate, for example taxation and working capital. We will see their details one by one and we will also solve their relevant examples. Before going into their details, it is important to know when to use nominal discount rate method and when to use real discount rate method. In order to decide, we will look for the following information into the question. For example, is there one rate of inflation? By one rate of inflation, we mean general inflation. Okay, general inflation. And no tax in the question. If the answer for both of them is yes, for example, the inflation is general in nature and there is no tax involved into the question, then we will look for the cash flows. For example, either the cash flows of the question are nominal cash flows or real cash flows. If the cash flows are nominal in nature, then we will go for money method. But if the cash flows are real cash flows, then we will go for real method. But if either the inflation is specific or either the tax is involved into the question, then in that case we will always use money method. Now it's time to solve some questions. On your screen you can see we have understanding number 4. Please let me zoom in for you. Okay, so first of all, please read the requirement of this question. Evaluate the project in terms of real cash flows and real discount rate. Then, in terms of money cash flows and money discount rate. Right? Let's quickly recall. In real cash flows, we have to multiply our real cash flows with our real discount rate, right? And in money cash flows we have 3 steps. For example, our step number 1 was to calculate nominal or money discount rate. Okay, so it was money discount rate. Step number 2 was to inflate the cash flows, and step number 3 was to discount them. Fine. So it was the 3 steps of calculating money cash flows. Now let's read the question. A project has following cash flows before allowing for inflation. Okay, so these cash flows are before allowing for inflation. So that means these are real cash flows. Okay, real cash flows. For example, all of these are real cash flows. For example, they are stated at their time zero values or year zero values, or these are real cash flows in other words. The company's money discount rate is 15.5%. So here you can see it is money discount rate. So that means it is our nominal discount rate. Fine, but the cash flows are not nominal in nature. The general rate of inflation is expected to remain constant at 5%. Right? So that was the requirement of the question. Let's solve the part A first. Okay, so first of all, we are going to solve the part A of this question, which is real cash flows and real discount factor. Okay, now quickly solve this example. Let's write the number of years here, year 0, 1, 2, and year 3. Then we have cash flows. In year 0 we have negative 750, then we have 330, then we have 242, and finally we have 532. We know that these cash flows are real cash flows. Now we will multiply it with real discount rate, but in the question we don't have real discount rate. Instead we have money discount rate or nominal discount rate. So we have to find out the real discount rate using this formula, which we have already seen in the previous lecture. So I am quickly calculating our real discount rate. So it should be 1.155 divided by 1.05. So here you can see it is our 10% discount rate. So our discount factor or discount rate is 10%. For the year 0, our discount rate or our discount factor will remain 1. Okay, but for the rest of the year we have to calculate our discount factor. So in order to calculate the discount factor of 10%, we have to use the formula, which was 1 plus r, and in this case 1 plus r, uh, r is 10%, which is our discount rate, and we have to take its power negative 1. Fine, I am going to paste it here, and I will simply change the number of years. Okay, so here I am going to multiply it with the relevant discount factor. I am going to copy this formula and I am going to paste it here. Now I am going to sum them up, and it's our NPV. Fine, it's our NPV. Now let's solve the same example using method number B. And now we want to solve the same example using money cash flows or money discount rate. Okay, or money discount rate. So we know that our first step was to calculate money discount rate. Okay, but in this example the money discount rate or nominal discount rate is already given, so we don't have to calculate it. Fine, now our step number 2 was to inflate the cash flows. I am going to simply copy these cash flows from here and I will paste them here, and here I am going to inflate them. So for the year 0 our inflation rate will remain 1, and for the rest of the year we will use the relevant inflation rate, which is 5% per annum. Okay, so I am going to inflate them with 5%, and I will take their power of its relevant year, which is year 1 in this case, and I am going to copy and paste it for the rest of years, but here I will slightly change the power of its relevant year. Okay, so now I am going to multiply it with their relevant inflation rate. Fine, and I am copy and pasting this formula. So these are our inflated cash flows. Okay, now I need discount rate at which we can discount them. So here I am going to discount them using 15.5% rate. I can simply copy this part from here and I can slightly change it. Okay, 15.5%, and here we have 15.5% or 0.155. Fine, I am going to copy it and I have pasted it, but here I will slightly change the relevant year. Okay, now I am going to multiply it with the relevant discount factor, so that we can have our discounted cash flows. Fine, so Here, if I sum them up, then you can see our NPV in both of these cases are same. Okay. Now let's solve another question. First of all, read the requirement of the question, which is evaluate the project assuming that machine has a life of 5 years and no scrap value. And the question is, a company is considering a cost saving project. This involves purchasing a machinery costing $7,000, which is our cash outflow, which will result in annual saving in real terms. Okay, so these cash flows are real cash flows on which we are saving $1,000, and on material we are saving $400 in real terms. The following forecasts are made for the rate of inflation each year for the next 5 years. Wage cost 10%. Now you can see these inflations are specific inflations. For the wage cost, we are expected that these wage costs will increase by 10% inflation per annum. Okay, and the inflation for material cost is 5%, while the general prices inflation is expected to be 6%. The cost of capital of the company in real term is 8.5, so it is our real discount rate, right? Now let's quickly solve this example. First of all, we have to see the total number of years. So in this question we have 5 number of years. Okay, so we will start it from year 0, then year 1, 2, 3, 4, and finally we have year 5. Then we have our initial investment of $7,000, which we will write in year 0. Here we have negative $7,000. Then we have cash inflow in a form of wage cost saving. Okay, but it is real term cash flow. For example, it is not inflated, but the examiner have given us the inflation rates, specific inflation rates. We will inflate the wage cost with its specific inflation rate, which is 10% in this case, for each year for the next 5 years. Okay, starting from the year 1. So here we are going to write wage cost, and we will inflate it by 10% per annum, right? So in the year 1 we have $1,000, but it is inflated, so we will have to inflate it with, let me add equal sign first, with 10%, that means 0.1. And here I am going to take the power of its relevant year, so it's year 1, so I am going to write year, I am going to write 1 here, fine. So that's how I get 1100. I will copy it and paste it in the rest of years, but I will slightly change the number of year, fine. Year 3, year 4, and here we have the power of year 5. So it is our inflated wage cost saving. Next we have material cost, and we will inflate it by 5%, right? We are going to inflate it by 5% per annum. We will do it exactly in the same way we did wage cost. So that's mean in year 1 we have $400, but we will inflate it by 1.05. 0.05 is 5%. And here we will take the power of its relevant year, which is year 1 in this case. Now I am going to copy it and I will paste it here. Again I will change the power with its relevant year, year 4, and here we have year 5, right? Now I am going to sum up them. So I am copying this and I will paste it here. So these are our inflated cash flows, right? Now I will multiply it with our discount rate. So here our discount rate should be nominal discount rate, which is not given in this question, but we will calculate it using this formula. 1 plus m is equal to 1 plus r. Okay, and we will multiply it with 1 plus I. I is our inflation rate, R is our real rate, and M is our money rate. Right? So our real rate in this case is 8.5%. So I am going to write 1.085, and I am going to multiply it with inflation rate, our general inflation rate, which is 6%, 1.06. Okay, so here I have 15% as a result, right? For example, if I less 1 from this amount and then I multiply it with 100, then I will get 15% as an answer. Okay, so our discount factor or discount rate is 15%. Now for the year 1, our discount rate or discount factor will remain 1, but for the next years we will take the discount factor. So we will use our formula. Let me end the bold sign from here. Okay, so to calculate discount factor, we know the formula 1 plus r, then we take its power by negative relevant year. So here 1.15, 1 plus r will be 1.15. Now we are going to take its power and negative 1. Okay, I am going to copy it and I will paste it here. Again, I will change the number of year from this formula, and now I will multiply it with our inflated cash flows so that we can have our discounted cash flows. I am going to copy this formula and I will paste it here. These are our inflated cash flows. If I press Alt plus, then it will sum up all of these values, and it is our NPV which is in negative. That means this investment proposal is not acceptable. Well, it's the concept, but here I can see a little error in the calculation. For example, if I check it, then it is sum up in the sum, it is also considering this one. So I don't want to take this one from the value. Let me check it. Okay. So I am going to copy and paste it. Fine. You should also take care of such a little mistakes in your calculation when you are solving the question. Okay. Now it's time to discuss the impact of corporation tax on our discount rate. Okay. If I talk about corporation tax, then we have two concepts here. One is tax charge and other is tax relief. By tax charge, we mean we have to pay some tax. For example, in the case of high profits, we have to pay higher tax, and in the case of low profit, we have to pay lower tax. On other hand, if I talk about tax relief, then the tax authorities may also give us tax relief in a shape of tax allowable depreciation, and it is allowed as an expense against profits. That means we can reduce our profits. So as you know, low profits is equal to low tax. So that's how we are getting relief, because we are deducting this expense from our profit and we are reducing our profit. Now it is an important point. Tax allowable depreciation itself is not a cash flow item. Okay, here you can see we have a performer related to our tax related working. Okay, here we will have initial investment or written down value, sale proceeds. Then we have tax allowable depreciation. Now this tax allowable depreciation itself is not a cash flow item, and we will not include it in our NPV calculation. But based on this tax allowable depreciation, we will calculate tax relief, and this tax relief is relevant to the NPV calculation because it is a cash flow item. Okay, now here we have another important point. Tax allowable depreciation is given for every year of ownership except for the year of disposal. As you can see here, the year of disposal or sale proceed is year 4. Okay, so we are not giving tax allowable depreciation in this year. Instead, we are deducting this amount from this amount, and that's how we have this amount. Fine, but we will still have tax relief in the year of disposal too. We have two methods to calculate this tax relief. One is straight line method and other is reducing balance method. And this method we are solving here is reducing balance method. Okay, let me briefly explain you the working we are doing here. Okay, first of all, in year 1 we have initial investment of $10,000. Then we are taking 25% of $10,000. That means 10,000 multiplied by 25%, and we have this amount. Fine. Now we are deducting 2500 from this amount from our initial investment, and that's how we get 7500. Then we are multiplying 7500 with 25% again, and we are getting this amount. Fine. And now we will deduct this amount, for example this amount from 7500, and then we will get this amount. Okay, and the same thing will apply here, but in the last year we have sale disposal, so we will not multiply 25% here. Instead, we will deduct this amount, the amount of our sales disposal, from our written down value. Okay, and after deducting it we will get this amount, on which we will have 30% tax relief. Fine. Now before solving any question related to it, we have few more points that you should know. Okay, the corporation tax is a relevant cash flow for NPV purpose. We have already discussed it. Tax is paid 1 year after when the related operating cash flow is earned. Okay, so it is an important point. If the examiner is silent, then we will also pay tax 1 year after when we will earn or when we are earning any operating cash flow, unless told otherwise. And here we have some assumptions. Operating cash inflows is equal to chargeable tax at corporation tax rate, for example let's say 30%, as in this case. That means if we are earning something or if there is inflow of cash, then we have to pay tax on it. Okay, that will be tax chargeable. While if we are expensing out something or if there is some cash outflow, then there should be a tax relief. Fine. And your initial investment will also attract tax relief in a shape of tax allowable depreciation. And another important point, a common assumption is that tax allowable depreciation will always be 25% unless told otherwise. Now here we have a question which is our understanding number 6. Let's quickly solve it. Okay, according to the requirement number A, we have to calculate tax allowable depreciation and hence the tax savings for each year if the proceeds on disposal of the asset are 2500. Okay, and the question is saying that an asset is bought for $10,000. Fine, it is our initial investment and will be used on the project for 4 years, after which it will be disposed of. Tax is payable at 30% 1 year in arrear. In arrear mean 1 year later, and tax allowable depreciation available at 25% reducing balance method. Fine. So let's start it. Here we have year 1, year 2, year 3, and year 4. In year 1, our initial investment is $10,000. Fine. And there is no sale proceeds in this year, but we have tax allowable depreciation which is attracted by any investment. Okay, so we have multiply it with 25%. Now we will multiply this 2500 with 30%, and that's how we will calculate our tax relief. Fine. So here we have the tax relief of 750 in year 1. Now in year 2 we will simply deduct this amount 2500 from $10,000 and we will get 7500. Fine. Again, I can copy it and paste it, and I am pasting it to this amount or this formula, sorry. Fine. And I am going to do the same for next year. I have done nothing, just copy pasted the formula because everything else is same. But in year 4 there will be no tax allowable depreciation on this amount. Okay, we will not use this formula which was we were using above. Instead, we will have sale proceeds here, which is 2500. Okay, it is 2500 in this example. So we have, let me add a minus sign. Okay, so we have the sale proceeds related to 2500, and we can now sum up both of them. Sorry, we are going to sum up both of them. Fine. And that's how we calculated tax allowable depreciation for the last year. And again, I am copying and pasting the above formula because we are going to take 30% on this amount. So this is the total tax relief we are getting, and this is our total tax allowable depreciation. Fine. Now I am going to solve the example number B. How would your answer change if the asset were sold for $5,000? Okay, so we have to do nothing, but we have to only change this sale proceeds amount. So I can copy this or paste below, or I can also amend this amount, and we will have our answer according to part B. Fine. But here we have a very important point. If you can see the tax relief here, then you can see it is in negative amount. That means it is tax payable. Okay, it is tax payable or tax chargeable. But if I talk about the previous case where we had 2500, here you can see it is not tax chargeable, instead it is tax relief because the amount is not in negative. Okay, that was an important point, please don't miss it. Now, according to the requirement number C, if net trading income for the project is $8,000 per annum, based on your answer to part A, according to this answer, and cost of capital 10%, okay, calculate NPV of the project. Fine. I have slightly zoom out so that we can see the full screen. Now we are going to solve the part C of our question, and I am going to copy it and paste it here, and here we are going to solve the part C of our question. Okay, first of all we have to see the total number of years of our project, which is 4 years in this case. So here I have year 0, 1, 2, 3, 4 and 5. Why I have written 5 here, I will tell you shortly. First of all, if the net trading income from the project is $8,000, so here you can see we are earning something, or there is some inflow, cash inflow, and as we studied earlier, there will be tax payable on cash inflow, right? So that means we will pay tax on this trading income 1 year in arrear, or 1 year after we are earning it. So here I am going to write our trading income, which is starting from year 1, and it is $8,000 for 4 years, right? And there will be tax payable on this amount, which is 30%, 30% in area. Okay, it is our tax payable rate, and we will pay it in area. That means we will pay 30% of this $8,000 in year 2. Okay, so I am going to multiply it with 30%, but here I will add a negative sign before this formula so that we can have our answer in negative. Right, I am going to copy this formula and I will paste it for the rest of years, and that is the reason why I added year number 5. So now I am going to add our initial investment, which was $10,000, negative $10,000 in year 0. Then we have a disposal of 2500, because we are assuming our answer is based on the part A, and we have disposal of 2500 on year 4. And finally we have tax relief from this part. We have tax relief of 30%, okay, and it is also in area, so we can simply copy it and we will paste it here. I am going to paste the values in transpose form, right? So now I am going to sum up them and copy this formula for the rest of years. So these are our total cash flows for 5 years. Now we will multiply these cash flows with the relevant discount factor, which is 10% in this case. So our discount factor is 10%, and for year 1 it will be definitely 1, but for next year we will calculate it. Okay, so we are going to calculate it for the rest of years, and I will slightly change the number of relevant year, 3, 4 and 5, and finally I am going to multiply this with this. Okay, these are our net cash flows and we are going to multiply them with our discount factors. So I am going to paste this formula for the rest of years. So these are our total discounted cash flows. Fine. Now if I sum up them, then we have the NPV of around 11801.15. Okay. Now our final topic is the impact of working capital on our discount rate. So we have the following two steps by which we can solve any adjustment relating to working capital which can impact our discount rate. So our step number one is to calculate the absolute amount of working capital. And the step number two is to calculate the incremental investment required. Don't worry about it. We will, when we will solve some questions, we will understand both of them. Okay. Each year, remembering to release all the working capital at the end of project. It is an important point. It is these are some further tips related to it. It is treated as initial investment cash outflow at the start of project. Any increase or decrease should take into account. We will consider the full initial working capital in the year one and only it is important point and only incremental working capital in the subsequent years. And finally, at the end of project, all the working capital is released and treated as cash inflow. All of these are important points. Okay. Now let's solve some examples to understand it. It is a pretty straightforward question, but you have to understand it. Now we are going to solve this question with the steps we have just learned from our notes. Okay. So our first step one was to calculate absolute working capital. First of all, let's see the number of years for which this project will remain. And these are 4 years. So I am going to write 4 years here. For example, year 0, 1, 2, 3, and year 4. Right? Now, according to this information, we have sales and working capital is 10% of our sales. So we have to calculate sales first so that we can take 10% of these sales as a working capital. Fine. So here we have sales and these sales are expected to be double to 5 in the first year. Okay. In the year 1 we have double to 5, but it is expected to grow with 5% per annum for the next years. So that means we will grow double to 5 with 1.05 for the next year. So here we are going to inflate it with year 1 because it is the first time we are going to grow it. But basically it is not the inflation, it is the growth in sales. Fine. So we are going to grow it for the first time. So I am going to write 1 here. Fine. Then I am going to copy it and paste it here. Now I will slightly change this value to and here I will write 3. Fine. Now here I am going to calculate our working capital, which was 10% of our annual sales. It was 10% of our annual sales and it was required to be placed at the start of each year. Even in the absence of this information, we will assume that working capital should be placed at the start of each year, but the examiner can tell you anything else otherwise. So here in year 0 we are going to take 10% of this amount. Okay, so here we are going to take 10% of double to 5. Right? And I am going to copy it and I will paste it here. Fine. So here I have working capital for 4 years, from year 0 to year 3. So that's how I calculated absolute working capital. That was pretty straightforward. Now, according to step number 2, we will calculate incremental working capital. Fine. So I am going to calculate here incremental working capital. In order to calculate incremental working capital, I will simply write number of years here, okay? Or I can copy it from above. I am copying it and pasting it. And just for reference, I can write my absolute working capital. Okay, so I am going to copy it and I am going to paste it. Fine. So now I am going to perform the last step, or it is our last line what I am going to write, but it is the most important part and you have to understand it. Fine. First of all, these absolute working capitals will not be the part of our NPV calculation. We will not take them as cash inflow or cash outflow. Okay, but here is what is relevant to the NPV part. Okay, so here we have cash flows. In year 0, as we are taking the working capital as investment, so we will treat it as negative amount. So in year 0 we have this amount and we will treat it as negative amount. Fine. Now here you can see we have an increase from 22 to 23 point something. So it is again an incremental increase in working capital investment. So that means it will also be a negative cash outflow. So to calculate it, we will use the working capital of year 0 and we will deduct the year 1 working capital from it. Okay, and we will copy it and paste it for the next 2 years. Fine. Now in the last year or in the year 4, we will release all of this amount which is present in the last year or in year 3. I am going to copy it and I am going to paste it here. So I am treating it as cash inflow. So just see the difference between these amounts. These are cash outflows, all of them, but this one is cash inflow in the last year, and these are the amounts which are relevant to the NPV calculation perspective. But one more thing, what if this amount decreased from 23 to, let's say, to 20 point something? In that case, that would be a positive or cash inflow amount. Okay, here you can see these two are, and this one including, these three are cash outflows, but this one and our last year cash flows would be cash inflow. So that's all for this lecture. See you in our next video.